If you make one balance sheet of all the households in India, this will look like this. It has 50% allocation to real estate, it has 15% in gold, it has 15% in deposits, then the insurance and provident fund and all of that. And equity allocation is less than 6%. It was less than 3% 10 years back. I can say the same about SIP. Till few years back, before the amount became large, people used to say कि नहीं SIP नहीं चलेगा India में because that's not something people are used to. They want to put lump sum. But now SIP has become such an acceptable. Probably we have one of the longest track record. I think 12 or 13 of our funds have been in existence for more than 15 years, and several of them 20, 25, 30 years.
Hello and welcome to the Beyond Returns podcast by ET Money. We are really excited about our today's guest, Mr. Navneet Munot. He is the MD and CEO of HDFC Mutual Fund. Now, Navneet has over 30 years of experience in the industry. He has seen the industry evolve from a tiny base to now over $850 billion. He has been a fund manager, a CIO, and now a CEO. So he has witnessed the industry grow from every possible angle. So given his vast experience, we are going to talk to him about the trends shaping the future of investing and mutual fund industry and what it means for you, the investor. Welcome to the podcast, Navneet. We are so glad that you could join us.
Thank you, Dinesh. Pleasure to be with you.
Thank you, Navneet. Okay, before we begin, I would just like to tell the viewers that there are some important disclaimers from HDFC Mutual Fund at the end of the video. So if they want, they can refer to them. All right. So here's my first question. So you have been a CIO for over 12 years, all right? And you've been a CEO for over 5 years. Now, during the span of this career, what are some of the significant changes that you have seen happening in the industry? I just want to specifically ask you from the money management perspective.
Okay. So in past 5 years, post-COVID, things have changed a bit as far as technology is concerned. Half the transactions of the industry used to be done digitally. Now you have like almost 96% or so of the transactions getting done digitally. From an investing perspective, nothing much has changed. Of course, some of the newer instruments may have become more popular, or primary market has become a lot more vibrant in last few years. You are seeing a greater participation of domestic mutual funds in the market. So the ownership of Indian investors has been increasing, while the foreign portfolio investors' ownership has been going down, which had to happen at some point in time. I mean, Indian market should be owned to a good extent by domestic investors, which is a very, very welcome change. Another interesting thing is that the way people are investing. I remember in my entire career for the first 20-25 years, people will ask कि अभी लगा दें या wait करें. And after the market has run up for a year or two, कि sir profit book कर लें या wait करें? Should we book profit or should we wait? Now it is very different. Most of the conversations are around like, long-term investing, SIPs, asset allocation, and some of those kind of things. So the awareness among investors have increased quite a bit. But from fund management perspective, I think the fundamental tenets of investing don't change much.
So if you look at the processes and things that were followed earlier, they are more or less the same, you're saying?
I would say they evolve over a period of time. So if you ask me as a market participants, in last 30 years, I've seen a journey from open outcry in Bombay Stock Exchange to an online trading, physical certificates to dematerialization, from Vyaj Badla to futures and options, swaps came, interest rate futures. We have seen like many changes, right? Even there was no word called NFO. It used to be called IPO. Even mutual fund used to come out with the IPO. So a lot has changed over a period of time in the market. I mean, you are not getting like live prices the way you get today. For most of the investors, they would read in the newspaper next day and then place a trade. So the markets have changed. In early 90s, the settlement cycle was not fixed, and now we have moved to T+1. So that way a lot has changed. technology has played a big role. Information, the way it get disseminated by the companies. Earlier, you will get like one annual report in a year. Now you have quarterly results and monthly data of every industry and so on and so forth. So a lot has changed, and the fund managers, analysts, everybody evolves with that time. But the fundamental tenets of investing, how do you invest, that doesn't change much. Yeah.
So I've heard a lot of times you draw parallel between the US and Indian markets, right? You've mentioned that what happened in the US 20, 30 years ago, we are witnessing something similar happening in India, right? I just want you to draw these parallels and explain where we are and where we could go if you look at the US market.
No, interesting question, and I've said many times. I think it was Mark Twain who famously said, "History doesn't repeat, but it rhymes." History doesn't repeat, but it rhymes, and there are some parallels between U.S. in 1980s and what's happening in India now, as far as capital markets and asset management industry is concerned. So, few changes that happened in 80s. So, 1980. Early 80s, Paul Volcker at US Federal Reserve said that I will break the back of inflationary expectations in US, and they increase interest rates to bring down inflation. And in 2016, India followed Monetary Policy Committee framework inflation targeting, where RBI said that we will anchor consumer price inflation around 4%. So that was like a big change. The second was Ronald Reagan saying government has no business to be in business. And you've been hearing Prime Minister Modi saying less government, more governance. Focus on ease of doing business. Focus on making it easier to do business. And like we sold Air India. The third was baby boomers in US and demographics in India today. And the fourth was the 401k, which is like US investors started investing for the long run through what is called 401k, which was like putting their retirement savings. Of course, it was done by the employers directly, and there were a few differences. But our SIP movement from 2016 onwards can be compared with the 401k movement. And what happened that time was like US economy, the size of US mutual fund industry, etc., was similar to where we are today. So we are like $850 billion today, where US was in late 80s. In the next 10, 12 years, they were $5 trillion, and today they are substantially higher. I think India is moving in that direction, and I remain very optimistic on the future of our industry. And as more and more people get confidence about the long-term potential of the economy, more and more people get very confident about investing for the long run. I think our industry has brighter days ahead, and we have like tremendous opportunity in our industry to serve millions of more investors than what we are doing today.
Absolutely. In fact, I don't remember the data exactly, but recently I was looking at some data which talked about how in 70s and 80s in the US, bank FDs, right, was a higher proportion of their savings, and gradually post that it started reducing. So I think we have also started seeing something similar happening in India.
So, Dinesh, if you see the household, if you make one balance sheet of all the households in India, this will look like this. It has 50% allocation to real estate. It has 15% in gold. It has 15% in deposits. Then the insurance and provident fund and all of that. And equity allocation is less than 6%. It was less than 3% 10 years back. 3 has become like, let's say, 5 or 6% now. But still has a long way to go, because equity allocation over a period of time, as people invest for long term, as people start focusing on building the retirement corpus by investing in a disciplined manner through SIPs, over a period of time, that proportion will keep increasing.
Got it. Got it. So you mentioned that we are about close to $900 billion. In
Roughly, I mean, yeah, 75 lakh crores is $850 billion or so. But yeah, we'll be hopefully touching $1 trillion soon.
So we are at $850 billion, and I think the industry is growing faster than the GDP of the country, right? So we can expect what the AUM maybe to double in the next 7 to 8 years, right? If I look at the growth.
I think faster than that because AUM grows because of two reasons. One is the mark-to-market gain. As markets deliver returns, your AUM will grow. On the equity side, I mean, you take a call in terms of what market will deliver, and on top of that, the SIP flows and the other flows that come to the industry. Together, that number should be higher, much higher than the nominal GDP growth over the next several years. So we should, over a period of time, the AUM as percentage of GDP, the AUM as percentage of deposits, the AUM as percentage of market cap, whichever way you look at it, I think that should keep growing.
Got it. So what my question is, or what I'm trying to understand here is that let's say in the next 5 to 6 years, the AUM may double, right? We may go from close to 1 trillion to close to 2 trillion over the next 5 6 years. Now, this kind of growth, which took us, all these decades to reach, will happen in a very short span of time. Basic compounding. But what I wanted to understand is if we are going to grow that fast, what are some of the shifts and trends that you see happening if mutual fund has to add another 800 billion to $1 trillion?
So our ownership of Indian equities will keep growing. Our ownership of Indian bonds as a percentage will keep growing. If you go back in history, last 35 years since foreign portfolio investors were allowed to invest in India, at one point in time, if I remember correctly, almost 23 or 24% of BSE 500 was owned by the foreign portfolio investors. And mutual funds would own like a low single digit number. Now that proportion has been changing. So now the DII, the domestic institution investors, that includes mutual funds, own slightly higher than the foreign portfolio investors. Over a period of time, as we mobilize more domestic savings, our ownership will increase. The another thing that's happening now that SIP flows are so large, if you, Dinesh, just calculate 29,200 crores into 12, that number is almost $39 billion a year. And this is growing every month. This number was 4,000 crores in 2017, became 8,000 crores in 2019, then 16,000 crores, and now 29,000 crores. And over the next few years, it'll keep growing. If that much of money is coming into the markets, this will also ensure that primary market remain robust. More and more number of new businesses, new companies are going to come to the secondary market. So overall, investable universe is going to expand. Newer instruments like we have seen REITs, we have seen InvITs, we are going to see more instruments coming to the market. And in fact, last couple of years, we have seen greater growth on the equity side, but I see a lot of potential for us to become larger on the fixed income side as well.
Can you elaborate on that? Become larger on the fixed income side, as in what can we expect as investors?
So, it's interesting. I talked about mutual fund AUM growing as a percentage of bank deposits. This number gets quoted in many places. But if you segregate the AUM between the equity and the fixed income and money market AUM, actually the fixed income plus money market AUM as percentage of bank deposit has come down in last 7 8 years since 2016 because the greater allocation in last few years have come to the has come to the equity market and not so much in the fixed income market. But people need allocation to fixed income also. Some of the investors are playing it through the hybrid funds or asset allocation products. But for retirees, for a lot of people who have need for regular income, who have need for, I would say, a protection of income, a protection of capital as a bigger objective, they would look at fixed income also. Industry has done very well. If you look at last 10 years, 15 years, 20 years track record of the fixed income funds relative to the overall interest rate environment in the country, funds have done well. And I see potential in growth of those products also.
Okay, so you're saying more money would flow there. I thought, right?
Of course, yeah. See, India is underinvested in equity, and that's why we are seeing like sometimes I say people say this financialization of savings And I say maybe within that, a bigger trend is equitization of saving, because people were under allocated to equity, and now they are allocating a little more to it. And in fixed income, the allocation was in different forms, whether it was bank deposits or whether it was their provident fund or PPF and some of the other instruments that they had. Over a period of time, there would be a role for fixed income funds also.
Hi. Before we continue with the conversation, there's one important thing I wanted to discuss with you. More than half of you who are watching this conversation have not subscribed to the channel. So if you like the work that we are doing, please consider subscribing. It will help us to invite such industry veterans to this platform so that they can share their knowledge and wisdom with you. All right, now back to the show. Right. In fact, I wanted to ask you this question later, but now that we are on this topic, let me ask it to you right away. So SEBI has already proposed debt sectoral funds, right? I want you to explain to our viewers what these are. And also, besides the sectoral debt funds, what are other products and solutions that they can expect from the mutual fund industry in the future?
So SEBI has come out with a consultation paper on having a look at the classification of mutual fund schemes. So as you know, every mutual fund can have one large cap fund, one mid cap fund, and one small cap fund, so on and so forth. And this has been the case right since 2018 when the last time classification was looked at. SEBI has always been very pragmatic, has always been focusing on innovation while keeping a laser sharp focus on investor protection and market regulation. But for growing the market, they've always been very open to newer ideas. And within that, SEBI has talked about life cycle funds or target maturity fund, or maybe the more focus on solution-oriented funds. You talked about sectoral debt funds. So along with the industry, they are exploring many more product categories within the mutual funds.
So what exactly are these sectoral debt funds? I mean, if I have to understand or explain to the...
So currently in the debt funds, you invest across sectors, right? You may have bank bonds, you may have bonds of, let's say, non-banking finance companies, NBFCs, you may have companies in manufacturing or other sectors. Sectoral debt fund will be like in equity, you have a sectoral equity fund. So let's say it's a BFSI fund. So this is, let's say, an NBFC sectoral debt fund where your investment is only in NBFC. In a way, there is a category called PSU and banking debt fund where the money is only invested in public sector companies and banks. That can be like loosely called as like maybe thematic debt fund. There could be more sectoral debt funds where the money is invested primarily in one particular sector rather than across many sectors.
Got it.
Within the fixed income. In equity, the sectoral and thematic funds have been around for a very, very long time.
Got it. See, now, as you mentioned, right, one of the things proposed includes life cycle funds and solutions-oriented fund, right? Now, if I look at the current offering from mutual fund industry, we already have similar funds, but we haven't seen a large amount of interest from investors for such offerings, right? Maybe they don't like the lock-in that comes with such products, right? So my question is, do you see there is scope for such products in India?
You made a very valid point that solution-oriented fund, be it retirement fund or children fund, they have a role to play. It makes it simple for the investors. It makes it convenient for the investors. It also aligns investment with a certain goal. And rather than investors doing their, choosing a couple of funds, they can put money in a solution-oriented fund if it is for a specific use like children's education or for creating a corpus for the retirement. But you are right that both these products have a lock-in. So in case of children fund, child turning 18 or 5 year, whichever is earlier, the same as with retirement, person turning 60 or 5 years, whichever is earlier. And actually 5 years is too short a period if you are investing for these kind of goals. But for variety of reasons, historically, investors have always preferred liquidity and they prefer T plus one. Of course, we had like fixed maturity plans, which were very popular: 3 year, 4 year, 5 year fixed maturity plans. There were even longer term funds also earlier. But I think investors want the convenience of putting the redemption. To be very honest, um, I can say the same about SIP. Till few years back, before the amount became large, people used to say कि नहीं SIP नहीं चलेगा India में, because that's not something people are used to. They want to put lump sum. But now SIP has become such an acceptable thing. SIP has become such a buzzword. It is not only mutual fund industry, but now the real estate industry, the pension industry, the insurance industry. I've heard things like spirituality in practice, SIP, car companies, EV sahi hai. So credit to the mutual fund industry and people like you. We have really made it popular. But I think the same thing is with solution oriented fund. That I'm very sure that at some point in time they will become more popular because they simplify a lot of things for people. And a lot of times people just redeem based on a news flow, or they get fearful during volatile times. But once you have invested in a fund where the name itself is children fund or a retirement fund, and you know that this money is for a goal and not to time the market, then I think the greater amount of discipline can come.
Absolutely. So there's an emotional attachment to the savings that you do, which makes you stay longer. I hope that's what you were saying.
Absolutely, yeah. You don't get swayed by the emotions that can lead to you not meeting your goals. So the two big emotions are like the greed and the fear. You don't get too greedy and put all your money in a certain kind of sector fund, or in a particular kind of fund, and you don't get too fearful and redeem your money. I think the solution oriented fund can give you, I would say, a more simpler way, a more disciplined way of investing for certain life goals.
Makes a lot of sense. Now, coming to the industry, sir, we have now close to 50 AMCs, and I think a lot more would join the industry. Now, I agree that we've spoken about the growth and the kind of phenomenal growth that we are going to see in the mutual fund space. But still, even if we consider the growth rate, do you see the scope for so many AMCs in India?
So, Dinesh, that's an interesting question. So, industry AUM, as we discussed, just crossed 75 lakh crores. And you said there are more than 50 asset managers. Now, let me ask you this question. I've seen days of industry when the AUM of the entire industry was less than 1 lakh crore. How many AMCs would have been there that time?
10 to 12 maybe.
So, sorry, 10 to 12. No, there were more than 25.
Okay. Okay.
So the industry AUM has grown 75 times and the number of players have gone up from 25 to 50. But very interestingly, several of those AMCs, those which were there in 90s when I started my career, a lot of global players, a lot of players started by professionals or institutions or conglomerates and all of them, they don't exist today. Newer players have come. There have been M&A, like at SDFC AMC. We acquired schemes of Zurich Asset Management in 2003 or so. And Zurich acquired ITC Threadneedle Asset Management Company. So they were like third merger that finally came to us. And in 2013 or so, we acquired Morgan Stanley Mutual Fund, which came in India in like sometime in mid-90s. So there have been like a lot of those mergers and acquisitions in the industry also. And I think the entry of newer players also in a way indicate the growth potential of the industry that everybody is feeling confident about. So for players like us who've been around for long, this is I would say a validation of our thesis that industry has a huge growth potential. And I wish that each one of those players would bring in good practices, will build the trust of the investors, and all of us together should ensure that everything that we do every day should be towards building more trust of each and every investor. Industry has tremendous growth potential, as we discussed in the beginning. I think all of us need to ensure that we maintain the trust and continue to strengthen the trust of our investor. This is a very noble profession. Managing somebody else's money is a huge responsibility. We are a trustee of somebody else's money, and I'm sure any player who has that deep inside them will do well.
So just wanted to understand, if I look at any other industry where the competitive intensity, if it increases, right, the first calamity is the price. So if I look at, let's say, telecom or any other industry, but in mutual fund, prices is not everything. Though India may be a very value conscious country, when it comes to mutual fund, it's all about performance. So my question is, what I wanted to understand from you, if the competitive intensity in an industry like AMC mutual fund increases, what is it that investors can expect? Because prices coming down is not something that would matter, or we see that happening in a big way.
Uh, Dinesh, thanks for asking that. It's very interesting, and a lot of credit to our regulators and our industry, which has always believed in co-creation, which has always believed in collaborating for the ultimate, good of our end investors. So India was one of the earliest countries to remove the entry load on mutual funds. If you look at our pricing structure in India, which is regulated, and as you know that as funds become large, the scale benefits are passed on to the end investor, and as the fund size grows, your TER on the regular plan comes down, so the scale benefit gets passed on to the end investor, and that is ensured that the product has been very cost efficient for every investor. And in fact, we were looking at some of the retail class funds in United States, where the industry has been around for more than 100 years. In mutual funds started in 1924 in the US, and if you look at the retail class shares, I mean they call it like just like we say the regular plan and the direct plan, and there are different share classes. And you look at like the pricing structure there, you take pride that in a country like India, where we are like 30, 40 years behind them in terms of the size of the industry, we have made it so cost efficient for a retail investor. Also, the amount of transparency which is there on the overall expense ratio, on the brokerage that is paid on, I mean, this is like what you see is what you get. I think we take a lot of pride in our industry, and tremendous amount of credit goes to our regulators for keep working with us to ensure that we remain very transparent, we remain very cost efficient, and we deliver value to our end investors.
If the competitive intensity goes up, what are the things that we can expect? Returns, we can't expect high returns because returns are a function of market and a lot of other things. So what are the other things that one can expect?
Returns are a function of two things, right? I mean, as far as active funds are concerned, one is the market return. In India, again, there's so much of transparency. You have a total return index, which includes like dividend reinvestment. Also, the indices are have a lot of like uniformity. I mean, if you look at the disclosures in India across time periods compared with the relevant index in the US, we will see different kinds of funds comparing themselves to S&P 500, and you see like very different styles, very different kind of underlying investments, and most of the people I've seen compare themselves with the same index. I think in India, again, like credit to the regulator and MFA together, we have worked on more transparency, and that's why the funds become like really comparable, and investors can see the performance of the fund manager. So one is the market return that you get, and second is the alpha that the fund manager generates over and above the benchmark index, and in fact sheet that is kind of available to every investor to look at.
Got it. Uh, Now, we started with the investment process. Just wanted to understand that if I look at the investment process, this is my understanding. We've seen that earlier, uh, times when you were the CIO, we've seen that one fund manager used to manage multiple funds, right? Over time, we've seen a structure evolve where one fund now has at least two, three fund managers. One wanted to understand that why this change? Is it because of the succession planning, or is it because the complexity of managing a fund has also changed over time?
No, not necessarily. I think different fund houses would have different approach. At our end, some of the funds, like for example, let's say a hybrid fund or then dynamic asset allocation fund like balance advantage fund, there would be multiple fund managers. There would be one who's doing the asset allocation, who's an expert on asset allocation, how much equity, how much debt. There would be one who's doing the arbitrage. There would be one fund manager who's looking at the fixed income part of the portfolio. There is one fund manager who's doing the stock selection, the equity part of the portfolio. But there are like equity funds where we would have a single fund manager and they are supported by the entire team. So while the fund manager is important, often people undermine the importance of the rest of the team, be it all the research analysts, be it the economists, be it the dealers, so on and so forth. And it's a team that also plays a very, very big role apart from the fund manager. Of course, the buck stops at the fund manager and they are the ones who make the final decision, but there is an overall investing framework, the role of the risk management team to ensure that the investments are made within that framework, within the offer document, within the investment template that a fund house has set for the fund manager. So all of that play a role. But different fund houses within that would have different approaches.
Recently, there have been a lot of changes at HDFC Mutual Fund in the past 2, 3 years, right? We've seen new fund managers coming in. Now, I just wanted to understand when you were, I mean, I don't know if calling a rejig would be a right word, but a lot of changes happened. And now, when you were, when the team was sitting and deciding how to structure these changes, what are the few things that you were keeping in mind, thinking about the future, that this space may evolve in such a way? So let's structure it in a specific manner. So I just wanted to understand when it underwent certain changes, what was the future thinking you had while implementing those changes?
So at our end, Tinesh, as you know, that funds have got a track record going back 30 years. There has been a time-tested investment philosophy which has worked across many, many, many market cycles, many business cycles, many economic cycles, and we have seen that period. I think a fund house delivers well, which put like four things in place for putting the risk adjusted returns over a long period of time. One is, I think, a clear cut investment philosophy, which I think has evolved for us over the last several decades. The second, you put a very robust research, and I think that we take deep pride in the quality of team that we have, the experience that we have, the processes that we have for our research. Third thing you need is robust portfolio construction. This is what every portfolio manager does within the guardrails that we set for themselves in terms of the sizing of the portfolio, whether they apply any top-down view or they are more bottom-up stock pickers, so on and so forth. So that's the portfolio construction. And last but not the least is the risk management, governance, supervision, all of that. And all these four play a role. I think for us, this has evolved over decades. You look at our fund's performance, probably we have one of the longest track record. I think 12 or 13 of our funds have been in existence for more than 15 years, and several of them 20, 25, 30 years. Some of the portfolio managers and analysts who have joined from outside, they all vouch for one fact, that this is a fund house where it is not only the individual brilliance or the individual experience which has been there, but also the rigor of processes that has been set painstakingly over several decades. So we take deep pride in that, and that reflects ultimately in the returns and the trust of 1.4 crore investors.
One thing is, when we are talking about the future of mutual fund industry, we also talked about parallel to the US, right? In US currently, the passive space is far bigger than the active space. Now, when we are saying that we can see similar trends happening in India, what happened in the US, what do you think will happen to the passive space in India over the next maybe a decade or two or three? Uh, do you see that in India we see a similar trend where passive becomes much bigger than the active?
So going back to my analogy of 1980s, so since then, so let's say a Fidelity or a Capital would have been managing 40, $50 billion, a JP Morgan Asset Management. Now they manage a couple of $1 trillion on the active side. The passive fund managers have also grown. Alternative fund managers have also grown. I think we are going to see something very similar in India. Active will grow, passive will grow, alternatives will grow. So all styles, all kinds of segments will grow in the capital markets. They will become bigger, and there would be, I think, growth for almost every segment. The difference between US and India, as I mentioned earlier, is that I think in India, we have been very conscious of the fact that we must deliver value to the end investor. Whether you call active, whether you call passive. I talked about the alpha track record of our funds over 15 years for several of our funds. And if you look at the total fees that an investor is paying, in the active fund, that includes the alpha we are generating, the service we are providing, the service that is given by the distributor, so on and so forth. And the overall cost of that in a highly transparent manner, if you compare with the US, where there are all kinds of entry loads and different kind of overlay of fees, etc. If you don't deliver value, then people will look elsewhere. But having said that, I think it's up to the investors. How do they create their portfolio? And we have like all the products available in the industry. We have been highly innovative and providing every solution to the end investor. And they need to look at holistically about ultimately the investment is not about picking this fund or that fund. It is about you have a certain goal. You have to then back calculate how much savings you need to put to investments, what is the right asset allocation that you do, and within that, how you create that portfolio. That is more important rather than keep comparing one fund with the another.
Absolutely. Thank you so much for joining us, and thanks a lot for your time. I hope we'll meet again, and I would like to talk to you about uh, things that investors should do, something that you just spoke, but because of paucity of time, we couldn't take it up in this podcast. So we'd love to have you again talking about how investors can improve their returns or what are the things that they need to do, and how they can actually, how they should rather manage their money. But for this podcast, thank you so much for joining us.
Thank you, Dinesh. Entirely my pleasure.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.